Hi everyone, this is Dao Chai. I'm at the University Library, so if you guys hear noise, students talking in the background, sorry about that. We are going to be looking at journalizing and posting adjustment entries for deferrals and accruals. This is Analyzing Business Transaction Part 5. Okay, let's begin with a little inspiration. Um, you don't get what you wish for, you get what you work for. Daniel Milstein. Okay, so business needs feedback about how well they are performing during the period of time. Accounting divides the economic life of a business into artificial time periods. This practice is periodicity assumption. Accounting time periods are generally month, quarter, or year. Many business transactions affect more than one of these arbitrary time periods. For example, a new building purchased by Citigroup or a new plane purchased by Delta Air will be used for many years. Um, it would not make sense to expense the full cost of the building or the plane at the time of purchase because each will be used for many subsequent periods. Instead, companies allocate the cost to the period of use. So determining the amount of revenues and expense to report in a given accounting period can be difficult. Proper reporting requires an understanding of nature of the business, and two principles are used as guidelines: the revenue recognition principle and the expense recognition principle. The revenue recognition principle. So this is how it's going to look like. So when a company agrees to perform a service or sells a product to a customer, it has a performance obligation. The revenue recognition principle requires that companies recognize revenues in the accounting period in which the performing obligation is satisfied. Let's assume our company right here, Conrad Dry Cleaners, so cleans clothing on June 30th, but customer did not claim and pay for their clothes until the next week of July. So under the revenue recognition principle, Conrad records revenues in June when it satisfies its performance obligation, which is when it's performed the service, not in July when they received the cash. On June 30th, the company will report a receivables on its balance sheet and revenues in its income statement for the service performed. The entry would look like this for June and July. Okay, so you see June accounts receivable, debit, and then service revenues credit, and then in July once they get the cash, we'll go cash debit, and then accounts receivable credit. So that's how it would look like, right? So our map for revenue recognition would be customer request service performed, cash received. So revenue should be recognized in the accounting period in which the service is performed. Okay, so now the expense recognition. So recognizing expense, a simple rule is follow. Let the expense follow the revenue. Thus, expense recognition is tied to revenues recognition. So apply to the preceding example. So this would mean that the salary expense incurred for performing the cleaning service in June should be reported in the same period in which it recognized the service revenues. So the critical issue in expense recognition is determining when the expense makes a contribution to the revenue. So this may or may not be the same period in which expense is paid. So if the company pays a salary incurred in June, and then until July, it would report salary and wages payable on June 30th on the balance sheet. So the practice of expense recognition is referred to as the expense recognition principle, often referred to as the matching principle. It dictates that the effort expense be matched with the resulting revenues. So expense recognition would look like this. It would say we get advertisement expense, utility expense, and then delivery. Then we match it up with the revenues for delivery. So that's how we recognize that. So if we look at the map, we'll look at the period assumption, right? So the economic life of the business, and we'll follow the expense recognition principle. We'll look at that. So we'll match the expense with the revenue in the period when the company makes the effort to generate those revenues. That's the expense revenues. Okay. So now we're looking at accrued versus cash basis of accounting, right? Just real quick, cash basis, not GAAP, so we're not going to use that, but I'll go over it anyways. So let's look at accrue first. Accrue basis is accounting. The accrue basis accounting means that transaction that changes a company's financial statements are recorded in the period in which the events occur, even if the cash was not exchanged. So for example, using the accrued basis means that the company recognizes revenues when they perform the service, right? So the revenue recognition principle. So even if cash was not received, likewise, under the accrued basis, companies recognize expense when incur the expense recognition principle, even if cash was not paid. That's what most companies uses, if not all. That's what they should be doing. Okay, so another alternative is for the accrued basis, the cash basis. Again, we don't use cash, okay? Cash-based accounting because it's not GAAP. But this is, if they do, this is what companies do. They record revenues at the time they receive cash. They record an expense at the time they pay out cash. The cash basis is appealing due to its simplicity, but it's often misleading in the financial statement. So, for example, it fails to record revenues for companies that does not that has performed service but not yet received payment. So as a result, cash basis may not reflect revenue in the period that they performed the obligation, which was satisfied. So that's why the cash basis accounting is not in accordance with GAAP. Okay, so here's a little example of that, just to go a little deeper so you guys can get a little bit of visual on the accrued base and cash base. So compare the accrued base number and cash base number. Suppose the fresh color paints a large building in 2016. It incurs and pays total expense, right? So salaries and paint costs of $50,000, and it bills the customer $80,000 but does not receive the payment until 2017. So on the accrued basis, it would look like they would report $80,000 of revenues during 2016 and when it performed the service, and then the company matches the expense of $50,000 to the $80,000 of revenues. So in 2016, it would have net income for $30,000. So the $30,000 of net income reported for 2016 indicate the profitability of the company during that period. So just look at the accrued basis. If you look at cash, it doesn't make sense, right? Okay. All right, so the need for adjustment entries. So in order for revenues to be recorded in the period in which the performance obligation is satisfied and for expense to be recognized in the period in which they incur, companies make adjustment entries. Adjustment entries ensure that revenue recognition and expense recognition principle are followed. So adjustment entries are necessary because the trial balance, like when we first put together of the transaction data, it's not going to contain the up-to-date and complete data, right? So the reason why is because some events are not recorded daily because that's not efficient, right? So for example, like supplies and earning wages of employees. Another reason would be costs not recorded during the accounting period because these costs expired through time and as a result recurring daily transactions. For example, building and equipment rent and insurance. Okay, so sometimes it may not or may be unrecorded, right? May not be recorded at all. Like utility bills or utility service bills will not be received until the next accounting period. Right, so those are some reasons why we need to do adjustment entries. Okay, so adjustment entries are required every time a company prepares the financial statement. The company analyzes each accounting in the trial balance to determine whether it's complete and up to date for the financial statement. So every adjustment entry will include one income statement account and one balance sheet account. Okay, so let's go. All right, so deferrals. So there's deferrals and accruals, right? Type of adjustment entries. So adjustment entries are classified either deferrals or accruals, right? So each of those have classes, sub categories. All right, so deferrals would have prepaid expense, right? Expense paid in cash before they're in use, and then unearned revenues, cash received before they're performed, before service are performed. And then you got accrued revenues, accrued for service performed but not yet received, right? So we performed the service, but we haven't got the cash yet. So that's accrued revenues. And then we got accrued expense incurred, but not yet paid, right? All right. Okay, so right here, we are going to assume that zero is using an accounting period of 1 month. Thus, the monthly adjustment entries are already made. The entries are dated October 31st. The first category of the adjustment entries defer. To defer means to postpone or delay. Deferrals of costs or revenues that are recognized at the date later than the point when cash was originally exchanged. Companies make adjustment entries for deferral expense to record the portion that was incurred during the period. Companies also make the adjustment entry for deferral revenues to record service performed during the period. So the two types of deferral that we're looking at here is the prepaid expense and the unearned revenues. So right now we got prepaid expense at 600 for debit, and then we got unearned service revenues. So that's going to be credit because that is a liability. Okay. Okay, thank you.